Here's a number that should stop you cold. The average American over 50 has more than 5 financial accounts. And research from the Employee Benefit Research Institute shows that the retirees who run out of money before they die consistently had more accounts, not fewer. More accounts meant more complexity, more fees quietly draining the balance, and more decisions at exactly the moment in life when bad decisions cost the most. Nobody talks about this. The financial industry has every incentive to sell you more accounts, more products, more complexity. Simplicity doesn't generate fees. Complexity does. Here's what the data actually shows. The wealthiest retirees, the ones who never had to choose between their prescriptions and their groceries, didn't get there by having more. They got there by being ruthlessly intentional about less. There are exactly 3 accounts that do everything you need after 50. One handles your daily life. One protects you from the disasters that will absolutely come. And one, the one most financial advisors spend the least time explaining, is the single variable that determines whether you retire comfortably or spend your final decade anxious about money. By the end of this video, you will know exactly which 3 accounts these are, what each one should contain, what each one should never contain, and the one mistake most people over 50 are making with each of them right now. You don't need more accounts, you need the right ones. Let's start with the first one, and it's probably already in your wallet. Account number 1 is your checking account. You already have one. The question isn't whether you have it, it's whether you're using it correctly. Here's the mistake that almost everyone over 50 makes with their checking account. They keep too much money in it. Picture this. You've worked for 30 years, you've been disciplined, you've saved carefully, and right now there is somewhere between $8,000 and $20,000 sitting in your checking account earning 0.08% interest while inflation quietly erases its value every single month. You're not being safe. You're being robbed in slow motion. Your checking account has one job. It is a transaction account. Money comes in from your paycheck or your income. Money goes out to pay your bills, your groceries, your gas, your subscriptions. That is its entire purpose. The rule is simple. Keep 1 month of living expenses in your checking account. Nothing more. If your monthly expenses are $4,000, keep $4,000 in checking. If they're $6,000, keep $6,000. Everything beyond that 1 month buffer is actively losing value sitting there and needs to move to account number 2. Now here's something most people don't think about. Your checking account should also have overdraft protection connected to account number 2. Not a credit card, not a line of credit. Account number 2. That connection is what gives you the safety net without the fees. One more thing. If your checking account charges a monthly maintenance fee, you are paying your bank to hold your own money. Call them. Ask for it to be waived. Most banks will waive it immediately for a customer who asks. If they won't, you're at the wrong bank. Your checking account is a tool. Use it like one. Account number 2 is your high-yield savings account, and if you don't have one yet, what you're about to hear might make you want to open one before this video is over. Most people think of savings accounts as boring, safe but slow, the financial equivalent of a participation trophy. That thinking is costing them thousands of dollars a year. Here's the reality. The national average savings account pays 0.46% interest. A high-yield savings account at an online bank right now pays between 4.5% and 5%. On a $25,000 balance, which is what most people over 50 should have in their safety net. That's the difference between earning $115 a year and earning $1,125 a year. Same money, different account, one phone call to set up. This account has 2 jobs. First, it's your emergency fund. The rule after 50 is 6 months of living expenses, not 3. Here's why. If you're 55 and you lose your income, finding a new one takes longer than it did at 35. 6 months gives you the runway to make a smart decision instead of a desperate one. Second, this account is the overflow from your checking account. Everything beyond 1 month of expenses in checking flows directly here. It earns real interest while it waits, and when you need it, It's there in one business day. There's one mistake people make with this account that quietly destroys its purpose. They treat it like a second checking account. They dip into it for vacations, for impulse purchases, for things that should come from the checking account. The moment you start doing that, you've turned your safety net into a spending account, and you've left yourself exposed. This account is not for spending. It's for sleeping at night. The best high-yield savings accounts right now are at online banks. Ali Marcus by Goldman Sachs and Sophie consistently rank at the top. No monthly fees, no minimums. FDIC insured up to $250,000. There's no reason not to have one. Here's the account most people get wrong. Not because it's complicated, but because nobody ever sat down and explained it clearly. Account number 3 is your long-term investment account. And before you switch off because you think investing is for younger people with more time, hear this. A 55-year-old who starts investing today and retires at 67 has 12 years of compounding growth. 12 years in a broad market index fund has historically turned every $10,000 into more than $31,000. That's not speculation. That's math. The mistake most people over 50 make with this account isn't investing too aggressively. It's not investing at all, or investing so conservatively that inflation quietly erodes everything they've saved. Here's what this account looks like in practice. It's your 401k through your employer if you're still working. It's your IRA, traditional or Roth, if you want tax advantages outside of work. It's a brokerage account if you've already maxed out the other two. You might have one of these. You might have all three. The specific vehicle matters less than what's inside it. What should be inside it? For most people over 50, the answer is simple. A low-cost broad market index fund, something that tracks the S&P 500 or the total stock market. Vanguard, Fidelity, and Schwab all offer these with expense ratios under 0.05%. That means for every $10,000 you invest, you're paying $5 a year in fees. Not 5%, $5. Now here's the part most advisors skip. After 50, your investment account needs one thing the younger version of you didn't need. A withdrawal strategy. Because the question isn't just how to grow it. It's how to take money out without triggering a tax bill that wipes out years of gains. The general rule is this. If you have a traditional 401k or IRA, every dollar you withdraw in retirement is taxed as ordinary income. If you have a Roth IRA, every dollar you withdraw is tax-free. That difference, over a 20-year retirement, can be worth hundreds of thousands of dollars. This is why account number 3 isn't just an investment account. It's a tax strategy, and the time to think about that strategy is now, not the year you retire. Here's the part most videos skip. The 3 accounts aren't separate decisions, they're a system, and the system only works when all 3 are doing their job. Your checking account handles today. 1 month of expenses, nothing more. It flows, it clears, it moves on. Your high-yield savings account handles tomorrow. 6 months of protection sitting there earning real interest, never touched unless you genuinely need it. Your investment account handles the future. It grows quietly in the background, compounding year after year, building the retirement you actually want, not the one you'll have to settle for. When these 3 accounts are set up correctly, something shifts. You stop making financial decisions out of anxiety and start making them out of intention. That's not a small thing. That's the difference between a retirement you planned and one that just happened to you. Here's your one action for this week. Open a browser. Pull up all the accounts you currently have. Count them. If the number is higher than 3, start simplifying. You don't need to do it all at once. Start with the easiest one to consolidate. Then the next. Give yourself 90 days to get to 3. Most people over 50 don't have a money problem. They have a complexity problem. And complexity is the one financial problem that gets worse the longer you ignore it. 3 accounts. That's it. You've always had enough. Now make sure it's working for you.